Hey, what's up, everybody? I want to make a short video update on today's CPI print. If you haven't already seen it, July was unchanged, and the core, that is ex food and energy, that was up 0.3%. That was expected to be up 0.5%. So way down on that July CPI. And I'm not really going to talk much about that other than to say, we are seeing, as I've been telling you, an economic rebound in July. And that was from a very significant resumption in the fiscal flows. We had a 180 billion deficit for the month of July. We saw a big job number last Friday. And when the economy grows, that means more supply. Okay, the output of product goes up, and that will start to mitigate the inflation situation. But I really wanted to make this video this morning just to point out the mindlessness of monetarists, of monetarism. I've always said monetarism is a mental illness, and most people suffer from this mental illness because they view everything through the lens of monetary policy. I do not concern myself with inflation or deflation or rate hikes or rate adjustments at all, rate cuts, because I understand what they are. And I've been trying to explain to you guys that monetary policy has very little effect on the economy in the aggregate. It can have an effect on financial markets in the short term because of behavior. The fact that most people, nearly everybody, like I said, views economic conditions through the prism of monetary policy, but they really lack a true understanding of the effect of monetary policy. All it is income redistribution and price adjustment. And so if you understand that, not only do you have a better or a correct grasp of what the impact on the economy is going to be, very little. It's just kind of like mixing the water around in the swimming pool a little bit, But, you're able to take advantage of the behavior of the monetarists. Like, classic case in point, last Friday we saw stellar job numbers. I talked about this. I made a video, and these guys sold. I mean, they sold on clear evidence of a rebound, of a reacceleration in economic activity. You don't sell stocks. I mean, we own stocks, presumably. I would think you want to own it because you want to participate in the profits, the growth in profits of whatever company you're buying. And if the economy expands, you're going to see a growth in sales, a growth in profits. I mean, it's ridiculous. And then today, on this number, they're all, this is manic behavior. They're all buying it back now. They're all short. So I hope this highlights, it's very important that you sit down and take some time to try to understand this. I said all along, it was never about inflation. It was never about rate adjustments by the Fed. Those things have very little impact on the economy as a whole. We had a sell-off in the stock market because, two things basically. A significant reduction in the amount of fiscal support when 2021 ended. And we started this year, 2022. There was a fiscal cliff. I had been talking about that leading up to the beginning of 2022. We lost the child tax credit payments. We lost the supplemental unemployment payments last summer. So there was a fiscal cliff. That's number one. Number two, and the economy was adjusting to that in January and February and March. And then we had the April massive tax drain of 325 billion, which I told you, that's just going to suck a lot of liquidity, massive amounts of liquidity out of the economy. We started to recover a little bit in May, and then we got hit with the June quarterly corporate tax payment, another 120 billion sucked out. It took time to recover those tax drains, especially now that spending has slowed down from the pace of last year and, halfway through the second half of 2020, when we were getting these massive, unprecedented stimulus packages because of COVID. It was never about inflation. It was never about rate hikes, nor will it ever be. Now, it might have an impact on various sectors of the market. You might want to concentrate in one sector as opposed to another. In other words, when we saw energy very, very strong. You had the sanctions and the Ukraine war and things like that. But I mean, in the aggregate, it was always only about fiscal and not about monetary policy. So if you view the market through the lens of monetary policy, if you view the economy and everything through the lens of monetary policy, and if you call yourself an investor, you are not an investor. You're basically just running around, from one headline to the next, throwing darts at a dartboard, where somebody's going to say something about, central bank's going to do this or that, and you're going to just impulsively react, reflexively react. You're not going to make any money. You're not going to make any money. I mean, in order to be a true investor, you have to have an understanding of basic macro conditions. And, that does not come from monetary policy. Even the Fed, they don't even understand what they're doing. Now, I have to say this, and I say that very honestly, because you see, the Fed does whatever these, nincompoops start screaming about. Oh, you got to raise rates aggressively. Well, that's what they do. They don't know. Powell doesn't know. They have no clue. And that goes for central bankers everywhere. I mean, you see it. You see it. So, how do I leave off this video? I'm just going to say that I hope this is becoming clear to you guys now. I mean, this is just like ridiculous, comical. Like today, market's up a lot. I've been telling you, I've been buying these dips. I don't even care what happens to the market today. I don't pay attention on a daily basis. It's not relevant. It's not important. As long as the things that I look at continue to be positive and supportive. Look, I already told you that mid-September, we're going to have some turbulence, a pullback, because you got another quarterly corporate tax payment. I told you last month already, I told you August was going to be a big month. We got a quarterly interest payment. I'm telling you these things in advance. I said yesterday, regardless of what the reaction is to the CPI number, you want to buy any dip. You really didn't have a dip today, but I was buying yesterday. I was buying the day before on those dips. As long as the fiscal remains in place, I mean, it's solid, and the economy is in a growth path. Sometimes it grows at 1.5% or 2.5%. Sometimes it grows at 12% when you have massive stimulus like we had in 2021. We're not having that now. But look, growth means the stock market is going to go higher. You don't sell growth. If you sell growth, you are an idiot. Plain and simple. Anyway, that's how I'm going to leave off, and I'll see you later with a new video. Bye.